of you watching this video must have felt a certain degree of scarcity of money in your lives at a certain particular point in time. No matter how much we try to save, most of us end up with a very small percentage of our monthly salary. Corporate employees would relate more with the bankruptcy by the middle of the month. What do? Well, a lot of people directly call their parents, friends, or even fiancé for support. But it is not a permanent solution and risks social humiliation. It is here that technology comes off as a saving grace. Instant loan apps tell you that you can pay your rent by taking money for a brief period with a promise that you will return in time. But most of the fish is dirty here, and very few are authentic apps. Resultantly, most people pay back with the loss of mental peace or even suicide in some cases. Namaste, welcome to TFI English, National Socio-Political Analysis arm of the TFI Media Group. I'm your host Apurva, and if you're watching us on Facebook, give our page a like. And if you're watching us on YouTube, like the video and subscribe to the channel. Coming back to the story today, in this video, I'm here to tell you what RBI is going to do with fake lending apps. So let's begin. According to the reports available in the public domain, RBI has decided to prepare a list of legal loan apps in India. The decision was taken in a meeting chaired by Nirmala Sitharaman, our finance minister. The gravity of the issue can be gauged from the fact that the meeting about saving 1.4 billion Indians from fake loan apps involved high dignitaries such as Finance Secretary T.V. Somanathan, Economic Affairs Secretary Ajay Seth, Revenue Secretary Tarun Bajaj, Finance Services Secretary Sanjay Malhotra, Ministry of Information and Technology Secretary Alkesh Kumar Sharma, and senior RBI officials. In the meeting, Nirmala Sitharaman expressed particular concern about the impact of illegal loan apps on the poor and vulnerable section of the population. The main concerns affecting the finance minister are exorbitantly higher interest rates and hidden charges that people are unable to comprehend due to lack of education and time. She also expressed her reservations about these apps being used for money laundering, tax evasion, breach of privacy of data, misuse of unregulated payment aggregators, shell companies, and defunct NBFCs. Now RBI will prepare a list of applications which are legally allowed to offer loans, and it will be handed over to the Ministry of Electronics and Information Technology. On its part, the ministry will hand over the list to owners of Play Stores, and they will be asked to take down other apps which are in the same category but have not been whitelisted by India's central bank. Historically, credit offtake has been one of the biggest problems for both governments and common citizens. For most part of our existence as a politically independent nation, citizens and industrialists both had their qualms about taking credit from banking institutions. Industrialists did not take it due to red tapeism diluting their chances of earning profits, and citizens were troubled due to bribery and commission cuts of middlemen. Also, paperwork was too cumbersome for a common citizen to engage with bank officials. LPG reforms did pave the way, but things were too slow by the end of 2014. Then PM Modi came and launched his financial inclusion initiative called Jan Dhan Yojana. He wanted every citizen of the country to save every penny in their personal bank accounts. This is why he made it easier for them to open bank accounts for anyone above 18 years of age. By the end of 2014, 53% of Indians had personal bank accounts. This number jumped to 80% by the end of 2017, and it is increasing further despite COVID hurdle. The uneducated section of the society, people out of the labor force, and women were the biggest beneficiaries. As of April 2022, Indian banks had liquidity of 1.7 trillion rupees only on the back of Jan Dhan accounts. Easier saving meant that people now had more leverage to spend money. Indians were quick to utilize these savings towards opening small businesses. To compensate for the shortcomings in savings, the Modi government launched various schemes such as Mudra Yojana and the credit-linked capital subsidy for technology upgradation, among others. Growth occurred, and as a result, inequality increased. Now, certain Raju, who used to work with a Shyam on a monthly salary of 30,000, now started to earn double the amount thanks to him opening his business. income, and this is where Raju felt the need to upgrade his living standard, and this is exactly where instant loan companies made their mark. While banks were busy recovering from NPAs, they were quite apprehensive about disbursing new loans. In that circumstance, digital lending came off as a saving grace for people. While in the year 2012, Indians availed only $9 billion worth of digital loans, the number took a near 12-fold spike in 7 years. Between two Cricket World Cup cycles, digital lending of Indians went up from $9 billion to $110 billion. This number is estimated to touch $350 billion in 2023. Majorly, digital loans are taken for a short period of time. In fact, it saw considerable increase during COVID times. In 2020, the year in which COVID struck the world, Indians availed loans with 30 days tenure in humongous proportion. A total of 0.9 lakh crores of short-term loans were disbursed by Indian fintechs and NBFCs. The disbursal of short-term loans indicates that people are most inclined towards getting instant dopamine hits rather than building strength to strength. Students end up taking credit for their birthday parties in clubs and canteens, while housewives end up taking loans for kitty parties. Proclivity towards instant gratification is the reason why bad faith actors have entered into this segment. Not every fintech and not every NBFC operates on moral and ethical grounds. In fact, as it turns out that most of them do not have any ethical principle other than profit, of course. Time and again, RBI cancelling NBFC registration keeps dominating headlines. In July this year, a report involving massive involvement of Chinese funds in NBFCs and fintechs had also sent shockwaves across the nation. What a lot of fintech companies do is that they start to disburse loans through nefarious means. They either do it through playing around rules of earlier approved terms of lending, or they float new apps in the market. For instance, suppose Shashi Ranjan is in desperate need of Rs 10,000, but his credentials among family and friends are down. Over a period of time, he has also destroyed his credit score by not paying back legitimate loans on time. So they are also reluctant to give him a loan again. Now Shashi searches for instant loans on a lending app. The lending app collects his request but can't disburse it due to his low credit score. But they can send ads of other apps to Shashi's phone. Whatever Shashi wants is available on this app. The application does not compel him to submit his Aadhaar, PAN or other intrinsic details. All they ask for him is his phone number and current address. He readily hands over these details to them and the loan is disbursed. While Shashi is busy spending the money, the instant loan application is preparing to collect it. Its preparation includes spying into his phone, collecting call record data, and figuring out his frequent call details. The intriguing thing is that they do it by asking users to allow them to access for the sake of prevention of fraud and other stuff. In other words, the problem here is not that they are doing illegal activities. Instead, the main problem is that they are doing legal activities through illegal means. Now, when the consumer does not repay loans in time, they regularly call him to harass and use soft coercion. In case the loan is not paid back in 1 or 2 days, the person is subjected to social shame. Their friends and relatives are called and given a detailed outlook of his financial condition. The final step is that of a threat calls. Loanee is threatened that the recovery agent will snatch every ounce of his blood to recover money. According to a report by the Economic Times, total 6 cases of suicides have been traced to loans from these apps. Number of suicides in official figures is no way indicative of the ground reality. Why am I saying this? Well, just like every other crime statistic in India, this number also seems to be affected by underreporting. In just one city of Hyderabad, 250 billion transactions have taken place within the first 8 months of this year only. Minimum amount involved in transaction was Rs 2,000 while maximum was Rs 20,000. Don't tell me it is not out-of-pocket expenditure for middle-class people. Apparently, Hyderabad is just the tip of the iceberg. Recently, the Enforcement Directorate found that instant loans worth rupees 4,000 crores were disbursed by the nefarious partnership of fintech firms and NBFCs. What these NBFCs used to do was that they used to lend their RBI issued license to fintech companies for a share of profit ranging from 0.5 to 1%. The most ghast fact about this investigation is that Chinese companies were found to be funding these fintech firms. Fintech companies provided total disbursement amounts which were given to NBFC to distribute. The lending NBFC was getting paid a hefty sum without investing anything, since the burden of recovery was on the fintech firms. NBFC deducts its fees from the loan amount itself. Moreover, in the name of processing charges, customers were forced to give another 15 to 25% of total loan at the time of dispersal itself. ED found that out of 4,000 crores these companies distributed, they had already recovered 700 crores before even transferring money to all the customers, all in the name of transaction fees. As soon as news about ED action on the instant loan sector came out, Google felt compelled to shelve itself from scrutiny. It instantly announced that in the first 6 months of this year, the Play Store has banned 2,000 applications. On the regulatory side, India's central bank already has a ready list of 600 such illegal apps, which they had prepared in November 2021. But the tech world is not static, and within 10 months, hundreds of such apps have marked their presence on respective Play Stores. Reports of the Modi government banning 300 of those have also emerged. Even offices of Paytm, Cashfree and Razorpay were also raided. But their China connection ended up hogging the limelight rather than their impact on the average Indian. It has taken us too long to recover from the NPA crisis. The policy paralysis had weakened our financial system so much that it took nearly 7 years for banks to free themselves of the systematic burden. In July this year, gross NPA was reported at 5.9%, a 6-year low with the prediction of improvement. Demonstratively, incomes of banks have now reached a level of stability and they have started to earn more profits. Now, banks are not reluctant to lend, which is manifested in their credit numbers as well. The problems related to instant loan apps have the potential to kill this enthusiasm and impact India's economic growth. India is striving towards becoming a $30 trillion economy in the next few decades. Problems are also knocking its doors. Other than policy issues, one big problem which can stop us from achieving this dream is that of trust. Yes, financial systems are built on trust. Without trust, it is next to impossible to carry out transactions, no matter how big or small they are. The last thing our policymakers would want is the impact of low trust in the lower income segment of the population starting to affect credit growth.